Hey there, econ students and teachers. In this video, we're going to be looking at two countries that are specializing in the production of a good in which they have a comparative advantage in trading with one another. The question we'll be answering is, how does a country know if it's benefiting from trade with another country? To answer that, we'll look at what's called the trading price, or the terms of trade, which is the price at which a country can import a good from a trading partner. We'll look at how that compares to the price at which a country can produce a good on its own. What we'll find is that through specializing and trading with other countries, countries can usually import goods at a lower cost than they could produce them for domestically. Enjoy the video. Head over to econclassroom.com to find lots of great resources for economics students and teachers. Be sure to subscribe to my channel. Have a great day. What we want to explore in this video is the concept of a trading price. We want to show how through trade, countries can get the goods that they do not produce domestically at a lower price than they would be able to produce them for on their own. So we're going to start with the same production possibilities model that we used in an earlier lesson. We've got countries A and B producing basketball shoes and basketballs. Country A, as we showed in an earlier lesson, is going to allocate all of its resources towards the production of basketballs and produce down here on its production possibilities curve. Country B, because it has a lower opportunity cost for shoes, is going to specialize and produce up here on its PPC. The prices we calculated from our earlier lesson are seen here. Country A, if it wishes to produce shoes domestically, must do so by giving up 1.33 basketballs per pair of shoes. Country B, if it wishes to produce basketballs domestically, must give up one pair of shoes for every basketball that it produces. In order to gain from trade, Country A must be able to get shoes at a lower price than 1.33 basketballs, and Country B must be able to get basketballs at a lower price than one pair of shoes per basketball. So let's determine a price that would benefit both countries. And the price I'm going to go with here, the trading price is less than 1.33 basketballs per shoe and less than one shoe per basketball. Let's look at the price of one shoe equals 1.25 basketballs. Now, what price does that give us for basketballs? Well, we can take the reciprocal of that. If one shoe costs 1.25 basketballs, to find the price of basketballs, I divide both sides by 1.25. And 1 over 1.25 gives us a price of basketballs of 0.8 shoes per basketball. So country B is now going to be able to get basketballs at a lower opportunity cost in terms of how many shoes it must give up. So the new basketball price is 1 over 1.25, which is 0.8 shoes per basketball. With these new values in mind, we can illustrate the gains from trade using the trading price between countries A and B for basketballs and shoes. Recall that country A is going to specialize in basketballs because it could produce basketballs at the lower opportunity cost. Before trade, country A could get up to 6 pairs of shoes if it gave up all of its basketballs. That was at an opportunity cost of 1.33 basketballs per shoe. Now it's going to have to give up fewer basketballs, only 1.25 basketballs, to get a single pair of shoes. Let's show the possible level of consumption with trade the country A will enjoy at the new trading price of 1.25 basketballs per shoe. To do that, it would help to pull up our calculator here. Before trade, recall country A could produce 8 basketballs or 6 pairs of shoes, giving country A an opportunity cost of 1.33 basketballs per shoe. If we do the math now, country A can consume 8 basketballs or divide that by 1.25, and that allows country A to consume up to 6.4 pairs of shoes if it chooses to trade all of its basketballs for shoes. So we can now show the new trading possibility line for country A. Country A can produce 8 basketballs or 6.4 pairs of shoes. It's going to be right up around here. And as we can see, country A gains from trade if it is able to exchange its basketballs at the now lower opportunity cost, giving it a new level of possible consumption beyond its original production possibilities curve. Now let's look at the gains from trade for country B. Country B used to have to give up 1 pair of shoes, it's right here, for every basketball. And that was visible in our PPC because it could produce either 4 pairs of shoes or 4 basketballs. Now country B is going to have to only give up 0.8 pairs of shoes for every basketball that it wishes to acquire. Let's take out our calculator again and determine the trading possibilities for country B at the exchange rate of 1 basketball for 0.8 pairs of shoes. So now for the 4 pairs of shoes that country B produces, it can give up only 0.8 of a pair of shoes per basketball. So I could divide this by 0.8 to get the new trading possibilities level for country B, and that is 5 basketballs. So we can go down here and draw a new dotted line using my trading price. And this means that country B can now consume up to 5 basketballs, and country A can consume up to 6.4 pairs of shoes. Both countries have gained from trade because a trading price that is favorable for both countries has been established. And that trading price was 1 pair of shoes for 1.25 basketballs, or 1 basketball for 0.8 of a pair of shoes. Both countries have gained from trade. A trading price has been established that is between both countries' domestic opportunity costs. Now, just to really drive this point home that both countries have benefited from trade with one another, let's assume that country B, which is specializing its production on shoes, decides to trade 2 of its pair of shoes for basketballs. How many basketballs can country B receive now that it trades compared to how many it could produce domestically when it allocated its resources between shoes and basketballs? Remember that before trade, the opportunity cost was 1 for 1. 1 pair of shoes could be given up in order to get 1 basketball. So if country B were producing 2 pairs of shoes, it could have only consumed 2 basketballs. But now country B can trade each of those pairs of shoes that it's producing for 1.25 basketballs. So how many basketballs can country B consume now that it trades? Well, for the 2 shoes, it can trade them for 1.25 basketballs each, giving country B up to 2.5 basketballs with trade. So now country B can consume at a point that I'll call point Y beyond its domestic production possibilities curve. Now, does country A also benefit? Let's see. Before trade, if country A had given up 2.5 basketballs, it could have produced 5.5 basketballs. In other words, it's giving up 2.5 basketballs. How many pairs of shoes could country A have received in exchange for those 2.5 basketballs? Remember that 1 pair of shoes cost country A 1.33 basketballs. So for 2.5 basketballs, it could have received 2.5 divided by 1.33. Let's do that calculation. Before trade, country A could have received 2.5 divided by 1.33, could have received 1.88 approximately pairs of shoes. And we can see that on our PPC before trade, because if we go up, we can see the potential output of country A before trade. And that would be at a quantity of 1.8 pairs of shoes and 5.5 basketballs. Now, with trade, country A can trade 2.5 basketballs to country B and receive, in exchange for those 2.5 basketballs, 2.5 divided by the new price of 1.25, which gives country A a potential level of consumption of, break out our calculator one more time, 2.5 divided by 1.25, that would be 2 pairs of shoes. And we can see that because along our new trading possibilities curve, country A is now able to achieve a point beyond what it could produce domestically. I'll call this point Z. And that happens to be at a quantity of 2 pairs of shoes. So points Y and Z in my graph here, points Y and Z, are points that would not have been attainable by countries A and B before trade. But because they are now taking advantage of one another's lower opportunity costs in the goods that they do not specialize in domestically, both countries are able to achieve levels of consumption beyond what they can produce domestically. Free trade based on the principle of comparative advantage allows countries to achieve levels of consumption beyond their domestic production possibilities. And as we've seen here, it's not that only one country benefits from trade, both countries gain from trade. They can benefit from the cheaper opportunity costs that their trading partners are able to achieve than they are able to achieve domestically.
Here we go.